Hey everyone, and welcome to today's Explainer. I am absolutely thrilled to share this one with you because, well, we're putting on our professional sell-side equity analyst hats today. We are going to conduct a rigorous, fully documented, data-driven fundamental valuation of Champion Homes, trading under the ticker SKY. Our ultimate goal here, to just completely cut through all the market noise, look strictly at the extracted financial filings, and figure out what this company is actually worth. So here's the situation that brings us to the table today. Champion Homes has seen its stock drop over 13% year to date. It's currently sitting nearly 27% below its 52-week high. And, when a company with historically strong fundamentals takes a hit like that, it begs a pretty massive question. Is this a falling knife, like a total value trap? Or is the market handing us this massive rebound opportunity on a silver platter? Let's look at the data.
Okay, let's just cut right to the chase and give you the bottom line up front. Based on our extraction of the filings, our calculated fair value intrinsic price for Champion Homes is a whopping $160.26. Now compare that to its last close price of just $72.84. We're literally looking at a scenario where the intrinsic value appears to be more than double what the market is currently asking you to pay. Let me walk you through exactly how we got there using our valuation models.
All right, Section 1, Absolute Valuation Models. Specifically, we're looking at the discounted cash flow, or DCF. To start things off, we're pulling out the heavy artillery, the DCF model. We derive unlevered free cash flows directly from the filings to estimate the actual cash this business is going to generate over its lifetime, and then we discount that back to today's dollars. When we stress test that model, the results are honestly pretty fascinating. If we project out free cash flow, we hit that $160.26 target. But hey, even if we run a much more conservative DCF based purely on earnings per share, which is often a stricter accounting measure, we still get a fair value of $148.55. Both absolute methodologies are pointing to massive, undeniable upside.
So, the absolute crucial point here is what this actually means for your risk. Based on that free cash flow model, we are looking at a staggering 54.55% margin of safety. Now, in value investing, your margin of safety is basically your cushion, right? It protects you against unforeseen economic shocks or, just simple modeling errors. A 54% cushion is absolutely massive. It essentially implies the market has aggressively mispriced the cash-generating power of this firm.
Moving on to Section 2, Relative Valuation Benchmarks. Let's compare Champion Homes to its own historical averages.
Any good professional analyst is always going to double-check their absolute valuation against relative multiples. Since we don't have a perfectly defined peer group in this specific data extraction, we compare Champion Homes to an incredibly reliable benchmark, itself. Just look across the board here. The price-to-earnings ratio is currently 19.37, notably lower than its 3-year average of over 22. Price-to-book sits at 2.53, down from almost 3. And enterprise value to EBITDA is 11.44. which is well below that 13.91 historical norm. By literally every traditional earnings and asset multiple, Champion Homes is trading at a really steep discount to how the market historically values it.
And taking that a step further, let's look at the enterprise value to sales ratio. Right now, the market is pricing SKY at 1.32 times its sales. Over the trailing 12 months, that average was 1.51, and over the last 3 years, it was 1.62. Basically, this means you are currently paying significantly less for a single dollar of Champion Homes revenue today than investors have been willing to pay over the last 3 years. The multiple contraction here is just severe.
Okay, Section 3, Auditing the Missing Models. We call this the constraint pivot.
Look, as professional analysts, transparency is everything. We absolutely must audit the models we skipped. Because we strictly rely on the provided filings and we refuse to just make wild external assumptions, we had to skip the sum of the parts model. We just didn't have the granular segment reporting. We also skipped adjusted present value, or APV, because we lack the detailed debt schedule needed to value the tax shield separately. And net asset value? Well, that's out too, simply because we don't have the line item details needed to accurately convert book value over to fair market value.
Oh, and we also tossed out the dividend discount model, but actually for a totally different reason. The source data shows that the trailing 12-month dividend compound annual growth rate has completely plummeted by 49.90%. A DDM is really only reliable when a company has a consistent, clearly stated dividend policy. With a drop that severe, projecting future dividends would be purely speculative, so we're leaning entirely on our free cash flow models instead.
Let's move to Section 4, a quick financial health check on the core fundamentals.
So the models show us deeply undervalued equity.
Sure, but we need to make certain our high valuation isn't just masking a distressed, garbage balance sheet. First up, let's check leverage. The debt-to-equity ratio sits at an incredibly low 0.07. This is a pristine, basically unlevered capital structure. The company is financing its operations almost entirely through equity and generated cash. That means bankruptcy or debt servicing risks are virtually non-existent here.
Next, we check short-term liquidity through the current ratio, which currently sits at a very healthy 2.71. This demonstrates that for every single dollar of short-term liabilities the company owes, it's holding $2.71 in liquid assets. Champion Homes has phenomenal short-term liquidity to easily cover any immediate obligations that might pop up.
Now, check out the real growth engine under the hood of this company, a 74.51% trailing 12-month free cash flow growth rate. I mean, wow! While net income might have had some historical fluctuations, the actual tangible cash being generated by the business over the last year has absolutely exploded. This right here is the exact rocket fuel driving our lofty $160 DCF valuation.
But we also need to check management's efficiency, right? Return on invested capital is currently 16.52%. Now, while the data does show this is down slightly from its 3-year and 5-year averages, let's be super clear. An ROIC of over 16% still represents incredibly robust and efficient capital allocation. This management team is generating excellent returns on the money they're plowing back into the business. Finally, Section 5, the final valuation verdict. Time to weigh the evidence.
Okay, so we've built the absolute models, audited our constraints, checked the relative multiples, and verified the pristine balance sheet. To set up our final thesis, we really have to contextualize the recent price action. Over the trailing 12 months, the stock has returned a negative 18.74%. It feels like bad momentum, right? But let's zoom out for a second. Over 5 years, it's up over 69%. And over 10 years, it has generated a massive 712% return. This company is a proven long-term wealth creator that is currently experiencing some really short-term price compression.
So, here is where we land. The underlying data strongly indicates that this stock is deeply undervalued. It's grounded entirely in its explosive 74% free cash flow growth, its completely unlevered balance sheet, and heavily compressed historical multiples. Our models consistently point to an intrinsic value nearly double its current trading price.
Which brings us to our final thought. The market is literally handing you a 54% margin of safety. The fundamentals are exceptionally clean. So as you look at that $72 price tag against a $160 fair value calculation, are you staring at a falling knife or literally the most mispriced cash machine currently sitting in the market? Think about that as you review the data. Thanks so much for joining me on this explainer, and as always, keep questioning the numbers.